Welcome to the Opening Bell Report.
Usually when we look at a stock chart that's dropped, 87%, the conversation is pretty short. It's basically a postmortem. We're looking at a corpse and trying to figure out the cause of death.
Right. At that level of decline, you're not usually talking about investment opportunities. You're talking about bankruptcy lawyers and investors just licking their wounds.
But today, we're doing something a little different. We're looking at a chart that, honestly, it looks like a crime scene. A huge vertical red line straight down. And we're asking a very, very uncomfortable question.
What if the market is wrong?
Exactly. What if the panic was so violent, so algorithm-driven, that it actually broke the math of the company?
It's the classic baby out with the bathwater scenario, but I mean on steroids.
So we're diving into an analysis report on MREO Biopharma. The ticker is MREO.
And just to set the stage for you, this company is currently trading for pennies. I mean, specifically between 60 and 64 cents.
Which, usually it just screams, stay away. But we've got this report. It's titled MREO at $0.60, the insane risk-reward trade you can't ignore.
We should be super clear here.
Yeah, right off the bat, this is a penny stock we're talking about.
Yeah.
We are not giving financial advice. We're not telling you to go open your brokerage app and smash the buy button.
Absolutely not. This is an educational deep dive. We're dissecting the logic of what's called an asymmetric trade.
Asymmetric, meaning the potential upside is mathematically way bigger than the downside.
Precisely. And in this case, the report's whole argument is that the downside is capped by something very tangible.
Hard cash.
Hard cash. So our mission today is to unpack this whole thing. We're going to look at why everyone panicked. Because, you don't drop 87% for no reason.
For sure. Then we'll get into this idea of a cash floor and walk through the specific trade setup the report outlines. Because honestly, the psychology you'd need to even look at this stock it's fascinating.
It requires you to fight every survival instinct you have as an investor. Your brain says run, but the math might be saying, wait a minute.
Okay, so let's start with the damage. Why is MREO Biopharma down 87%? I mean, stocks don't just implode like that without a catastrophe.
And it was a catastrophe, at least for their lead asset. The company had a drug called setrusumab.
Okay.
And in the biotech world, your lead drug is everything. It's your flagship. It's the horse you're betting the entire farm on.
And the flagship sank.
It failed.
Right.
And when a lead drug fails in clinical trials, the market reaction is just, it's binary. It's not let's adjust down 10% kind of situation.
No, it's an immediate, violent repricing of the company's entire future.
Right, because all that R&D money is just gone. And the future revenue that was modeled in all those Wall Street spreadsheets just vanishes.
It goes to zero.
To zero. The report describes the mood as running for the hills. It uses words like ugly and says the perception is basically immediate bankruptcy. The stock went from $5 to 60 cents.
That is a bloodbath. But here's the pivot point in the analysis, and this is where it gets interesting. The report argues that this failure, this catastrophe, is actually a good thing for a new investor.
Not for the old ones, obviously. They got crushed.
Right. But for someone looking at it today, why?
It comes down to this concept of certainty. See, markets hate uncertainty. They hate maybe. They hate we'll see.
Okay.
Before the drop, there was a risk the drug might fail. Now, it has failed. That's a known fact.
But the bad news isn't some surprise lurking in the shadows anymore. It's just out there.
It's out there. The report argues the failure is fully priced in, the damage is done. And once the dust settles, you can walk into the crater and see what's actually left standing.
And that brings us to the core argument of the report, this valuation disconnect.
Right. This is where we talk about the relationship between the company's stock price and its bank account, the EV to cash ratio.
Okay, let's pause there and define that, because enterprise value, or EV, gets thrown around a lot. How is that different from just, the market cap?
Think of market cap as the sticker price to buy the company's equity. But enterprise value is a more complete picture of what it would actually cost to take over the whole thing.
How so?
Well, it takes that market cap, adds the company's debt, and this is the key part here, it subtracts the cash it has in the bank.
Okay, let me try an analogy. If I buy a house for $1 million, that's the market cap.
Right.
But if I walk inside and find a suitcase with $200,000 sitting on the kitchen table,
then your effective cost for the house, your enterprise value, is only $800,000. You paid $1 million, but you immediately got $200,000 back.
That makes perfect sense. So looking at MREO, the report highlights they have roughly $41 million in cash.
$41 million. Just sitting in the bank.
And at 64 cents a share, the market cap is just a little over $100 million.
So the market is saying the whole company's worth $100 million, and 40% of that is just cash in a checking account.
But it's actually even more distorted when you look at the liquidation value, isn't it?
It is. The report argues that if you strip out all the liabilities, the stock is trading perilously close to the value of its cash. alone.
So back to the house analogy, that's like buying the $1 million house, but finding out there's a suitcase with like $950,000 in it.
Exactly. So you're basically paying 50 grand for $1 million house.
Wow.
The report's thesis is that at this price, investors are essentially buying the cash, and they're getting the rest of the company for free.
And the rest of the company isn't just office furniture.
No. Even though their lead drug failed, they have another asset called alvelestat. It's a completely different drug in their pipeline.
But the market is valuing alvelestat at zero.
Right now. Yes. The panic over the lead drug was so extreme that the market just wrote off everything else. They assumed if the lead horse died, the whole stable must be empty.
That just seems so inefficient. I mean, how do they miss that there's a second drug that might be worth something?
Well, they don't necessarily miss it. They're pricing in a different risk.
Which is what?
Cash burn.
Yeah. Right. The fear that they'll just spend that $41 million keeping the lights on before they can make any money from that second drug.
Exactly. A biotech with no revenue is just a cash incinerator. So if the market thinks they'll go broke in 6 months, then yeah, trading at cash value makes sense because that cash is about to disappear.
But the analysis report has a counter to that too.
It does. It points to the runway. The analysis says MREO has enough cash to operate into 2027.
2027? That's years away. That's a lifetime in the market.
And it's a huge buffer. They are not going broke next week. They have years to develop alvelestat, or find a partner, or pivot.
So if the bankruptcy risk is off the table for the near term and the stock is trading at its cash value,
then the downside should be limited. I mean, you can't really value a dollar bill at 50 cents for very long.
And that's the cash floor theory.
That's it. The report argues that 60 cents acts as a hard floor because smart money, the investors who actually read the balance sheet, they'll step in and buy it. They know they're getting a dollar for 60 cents.
Okay, so we've got the floor, we've got the panic, we've got the remaining assets priced at zero. Now, the big question is, why buy it? I mean, just because it's cheap doesn't mean it's going up. It could just be dead money.
Right, and that's where we get into the contrarian thesis. The report argues that the drop wasn't just human panic. It was largely algorithmic.
We hear this all the time. The algos did it. What does that actually mean here?
Well, a lot of algorithms are just momentum-based. They see selling volume, they see a price level break, and they just execute sell orders. They don't stop to read the press release about the cash runway.
They just see down, so they press sell.
Pretty much. And the report calls it an algorithmic overshoot. So the robots basically smash the price down below what a rational human would value it at.
And that creates a vacuum.
Yes. When the selling pressure from the machines finally burns out,
Yeah.
you have a setup for a potentially violent reversal.
Violent in a good way, hopefully.
Yeah. If you're long, yes. The report talks about pivot potential because the stock is priced for death. Any good news about that other drug, alvelestat, could act as a massive catalyst, even a rumor, a new partnership.
Because expectations are already on the floor.
Exactly. It's much easier to exceed expectations when the bar is literally lying on the ground. The report suggests the stock could double to $1.20 very quickly on just mild positive news.
Okay, I want to pivot to the how, because the theory is great, but execution is where people lose money. The report lays out a very specific trading plan. This isn't a buy and hold thing, is it?
No, and that's a crucial distinction. This is a trade. It's a probability bet. The report suggests an entry zone between 60 and 65 cents.
So you're buying right on that cash floor.
You want to be as close to it as possible. But here is the most important number in the whole report. If you take nothing else away from this, remember this number, 50 cents.
The stop loss.
Yes, the report is adamant. If the stock drops to 50 cents, you sell. You get out, no questions asked.
Why 50 specifically? Why not hold and hope?
Because 50 cents is what the report calls the thesis breaker. If it drops below that, it means the cash floor logic is broken. The market has decided that cash is meaningless for some reason.
Yeah, at that point, you're not an investor. You're a gambler holding a losing ticket.
You got it. And that discipline is so hard for people.
Oh, it's the hardest part. Taking a loss hurts the ego.
It does. But look at the math, and this is where it gets really compelling. If you buy at 60 and you sell at 50, you lose 10 cents a share.
Okay, 10 cents of risk.
Now look at the targets. Target 1 is 90 cents. The report mentions a technical idea called a gap fill.
Explain that. What's a gap fill?
Well, when the stock crashed from $5 down to 60 cents,
Yeah.
it happened so fast it created a void or a gap on the chart. There was almost no trading in between.
A liquidity void.
Exactly. And technical analysis says that price often wants to travel back up to that void to test old levels. It can move up pretty easily because there's no memory of selling pressure there.
Okay, so that's 90 cents. And target 2.
$1.20.
100% return.
So let's look at that risk reward again. You're risking 10 cents
The drop to 50.
to potentially make 60 cents. The jump to 120.
That is a 1-to-6 ratio.
That's the asymmetry. And this is why it matters so much. You could be wrong on this trade 5 times in a row, lose 10 cents 5 times, that's a 50-cent loss.
Right.
But if you're right on the 6th time and you make 60 cents.
You've wiped out all your losses and you're still in profit.
Exactly.
Right.
It completely changes how you think about winning. You don't have to be right 50% of the time. You just have to find setups where the math is tilted in your favor.
But, and there's always a but, to get that payout, you have to do something that feels awful. You have to buy a stock that just lost 87% of its value.
The report has a great quote on this. The best trades always feel uncomfortable.
It's so true. It runs completely contrary to human nature. We want safety. We want to do what the crowd is doing. If everyone is selling, our brains are screaming, sell.
It's evolutionary, right? If the herd is running away, you should probably run too, or you get eaten by the lion.
Yeah. But in the stock market, if the herd is running away, they're usually leaving value behind. They're dropping their wallets as they run.
The report makes this distinction between the crowd and what it calls the opening bell army. I like that.
Me too. What's the difference?
The crowd acts on pure emotion, fear. They see red, they panic, they sell to stop the pain.
And the army.
They act on data. They see the red candles, sure, but they're pulling up the balance sheet, they're calculating the cash per share. They're the ones saying, wait a minute, this math doesn't add up.
It's like you have to turn off your emotions and become an algorithm yourself.
A smarter algorithm.
Yeah.
You're exploiting the fact that the dumb algorithms overshot the mark. They created this gap between price and value. Your job is to step into that gap.
But you only step in with a parachute. That's the stop loss.
Exactly. You don't step in with faith. You step in with a plan. You say, I'm betting the market is wrong, but if the price hits 50 cents, I admit I'm wrong and I get out.
It sounds so simple when you say it, but in the heat of the moment, when that ticker is flashing red,
It's incredibly difficult. That's why most people lose money. They buy the hype at the top because it feels good, and they sell the panic at the bottom because it hurts. This strategy is you buy the pain.
buy the pain. So to wrap this up, we have MREO Biopharma, ugly chart, failed drug, investors fleeing.
It looks like a total disaster.
But under that disaster, there's $41 million in cash, a runway to 2027, and a second asset priced at 0.
And a trade structure that offers 6 units of reward for every 1 unit of risk.
Assuming you have the discipline to actually honor that stop loss.
Which is the biggest assumption of all.
It really forces you to ask a kind of philosophical question about the market, doesn't it? We tend to think the stock price is the truth.
Right. But this suggests that sometimes the price is just the mood. It's like that old Benjamin Graham quote. In the short run, the market is a voting machine. In the long run, it's a weighing machine.
And right now, the voters are in a panic. They're voting 0.
But the weighing machine might say 41 million plus.
And if you can keep your head while everyone else is losing theirs,
You might just find a bargain.
or you might catch a falling knife. That's the risk.
That is always the risk. There are no guarantees, only probabilities.
So here's the question for you listening. Would you take that bet? Does the logic of the cash floor hold up for you, or is the momentum of that crash just too scary to step in front of?
It's a test of your trust in math versus your trust in the crowd.
Something to think about. Keep looking for that hidden logic in market panics. You never know what you might find. Thanks for diving in with us today.
Until next time.
See you next time.
Don't forget to like, share, and subscribe for more.